So good evening. Today we will be discussing on variance analysis. So when we talk about variance analysis, it is a technique used to analyze. It is a technique used to analyze and understand the difference between the actual performance and the planned performance. So when we talk about the variance analysis, it is a quantitative. It is a quantitative method used to analyze and understand the difference between the actual performance, and planned performance. So it is a quantitative method used to analyze and understand the difference between the actual performance and planned performance. So these variance analysis, we normally say that it is powerful. It is a powerful tool. It is a powerful tool for identifying. It is a powerful tool for identifying the areas of improvement. It is a powerful tool for identifying areas of improvement and optimizing business outcomes. It's a powerful tool for identifying areas of improvement and optimizing business outcome. So variance analysis compares the actual results. It compares the actual results with the planned or budgeted results, highlighting areas of deviation, and underlying causes. So variance analysis compares the actual results with the planned or budgeted results, highlighting areas of deviation and underlying causes. So variance analysis. This variance analysis helps organizations to, number one, we can talk about identify areas of inefficiencies. Then number two, the variance analysis helps organization understand the root cause of inefficiencies, and also it helps organizations to to take corrective action and improve on performance, to take the corrective action and improve on performance. And also we can talk about refine future planning and forecasting, So the variance analysis will help the organization identify the areas of inefficiencies, understand the root cause of inefficiencies, take corrective action and improve on performance, and also refine future planning and forecasting. Then we have the benefits of variance analysis. One of the benefits of variance analysis is that variance analysis will help in improve decision making. It will help the organization in improving the decision making, because they are going to know the variances, therefore helping them in arriving at a good decision. Then number 2, we can talk about the cost control. In this case, it is going to help the organization to optimize on cost reduction. Then number 3, we can talk about the performance evaluation, where it will help under the departmental evaluation and managerial evaluation. And also we can talk about the forecasting, whereby it will help in coming up with good future budgets, which will not have a lot of differences. So those are some of the benefits which will arise from the variance analysis. Then, other than the variance analysis, we have the types of variances. We are going to look at the types of variances. And when we talk about the types of variances, is that variances are broadly categorized into 2. These variances are broadly categorized into 2. They are broadly categorized into 2. We are going to look at what we call the cost variances, and also we have what we call the revenue or sales variances. We have the cost variances and revenue or sales variances. So under the cost variances, we have various costs. So we have the cost variances. And under the cost variances, the first variance that we are going to discuss is what we call material variances. And for the case of the material variances, the number A, we need to know on how are we going to get what we call the material cost variance. So the material cost variance will be given by the standard material cost. You take the standard material cost, then you raise the actual material cost. Then, other than the material cost variance, under the material variances, we have what we call material price variance. For the case of the material price variance, is given by, we'll be talking about the actual quantity into actual quantity, then into we have the standard price, then minus the actual price. Then the third one, we talk about material usage variance. Material usage variance can also be given by the standard price into standard quantity, then you raise the actual quantity in this case. So all this information can be presented in a table. Remember, for us also, other than following this formula, for us to get the material cost variance, you can take the material usage variance, then you add the material price variance. Let us present that information using a table. So up on the top, we are going to have the material cost variance. This material cost variance is made up of two variances, whereby we have the material price variance and we have the material usage variance, whereby under the material price variance we have said that it is given by the actual quantity into the standard price of the material, then you raise the actual price of the material. And in case of the material usage variance, we have said that it is given by the standard price into the standard quantity, then you raise the actual quantity. So for us, when you take the material price variance, then you add the material usage variance, you are going to get the material cost variance. So this material cost variance can be further subdivided into what we call the material mix variance, and also we have the material yield variance. So you are going to get the material mix variance and material yield variance, whereby you have more than one ingredient in a product, whereby, for example, you have material A and material B. In a product is made up of material A, this is material. They are talking about, for example, direct material. You have A and B. So in this case, you can see that we have ingredient A and ingredient B, so that it can help us to make a product. But whereby we only have only one material, therefore in that case we have only one ingredient, the material mix variance and material yield variance will not arise. Whereby we have more than one ingredient, then we can have the material mix variance and material yield variance. So the question will arise, how are we going to compute the material mix variance? The material mix variance is given by the standard price into, we'll be talking about the standard mix of actual input, then we less the actual mix. We'll be taking the standard mix of actual input, then we less the actual mix. What about the case of material yield variance? The material yield variance in this case, it is going to be computed by, you will be taking again the standard price, but now in this case into what we call the standard quantity, then you raise the standard mix of the input, the standard mix of the input. So that's how you will be getting the materials. And remember, we have said, other than taking the standard material cost and raising the actual material cost, you can get the material cost by taking the material price variance, adding with the material usage variance. That is the first variance under the cost. Under the cost, we have the material price variance. Then, other than the material price variance, the next variance we are going to look at is what we call the labor variance. We are going to look at the labor variance. The next one will be the labor variance. And when we talk about the labor variance, how do we get, so number B, Roman 2 now. Roman 2, we are going to talk about the labor variances. Labor variances. And under labor variances, the first case we will look at is labor cost variance. And in this case, how are we going to compute the labor cost variance? The labor cost variance will be given by the standard labor cost, then we raise the actual labor cost. You take the standard labor cost, then you raise the actual labor cost. Other than the labor cost variance, we have the labor rate variance. How do we compute the labor rate variance? The labor rate variance in this case will be given by the actual hours. You factor out actual hours into what we call the standard rate per hour. Then you raise the actual rate per hour. So that's how you get the labor rate variance. So other than the labor rate variance, we have what we call the labor efficiency variance. So how do you get the labor efficiency variance? The labor efficiency variance, in this case, the labor efficiency variance will be given by, you factor out the standard rate into standard hours, then you raise the actual hours. That is how you are going to get the labor efficiency variance. Other than the labor efficiency variance, we can talk about the labor idle time variance. The labor idle time variance. How do you get the labor idle time variance? The labor idle time variance will be given by, you are going to get the standard rate into actual hours worked, then you raise the actual hours paid. That is how you are going to arrive at the labor idle time variance. Those are the variances which are attached to the labor variances. And remember, again, for you to get the labor cost variance, other than taking the standard labor cost minus the actual labor cost, you can just say you take the labor rate variance, then you add the labor efficiency variance. Then another cost variance is what we call the overhead. And under overhead variance, they are categorized into two. So we are going to talk about the overhead variances. And when we talk about the overhead variances, number A of the overhead variances, we are going to talk about the variable. We have the variable overhead variances. So for these variable overhead variances, one of the variable overhead variances, we have what we call the variable overhead cost variance. Variable overhead cost variance. And how do we get the variable overhead cost variance? The variable overhead cost variance, it is going to be given by the standard variable overhead cost, then we raise the actual variable overhead cost. Then from there, the next question you will ask yourself, how do we get now another variable overhead known as the variable efficiency. Sorry, variable overhead efficiency variance. How do you get the variable overhead efficiency variance? So for you to compute the variable overhead efficiency variance, number one, you need to remember on how to compute the overhead absorption rate. And from the knowledge of a topic known as overhead, we say that for us to compute the overhead absorption rate, we normally take the budgeted cost, the total budgeted cost, then we divide by the cost driver. You will be taking the total budgeted cost, then you divide by the cost driver. So the question now arises on how are we going to compute the variable overhead absorption rate. The variable overhead absorption rate in this case will be given by the standard cost, total standard cost of total variable standard cost. Then we divide by the cost driver, and the cost driver in this case will be the standard hours. So once we get the variable overhead absorption rate, we take our variable overhead absorption rate then into what we call the standard hours, then we raise the actual hours. That is how we are going to get the variable overhead efficiency variance. So other than the variable overhead efficiency variance, the last variance under variable overhead variance is what we call the variable overhead expenditure variance. For the case of the variable overhead expenditure variance, we are going to take the actual hours. You take the actual hours, then you multiply by the variable overhead absorption rate. Then from there you raise the actual variable overhead cost. So for you to get the variable overhead expenditure variance, you will be taking the actual hours, then you multiply by the variable overhead absorption rate, then from there you raise the actual variable overhead. Then let us look at the next overhead. The next overhead is what we call the fixed overhead variances. So let us look at number B under that. What we call number B under that, we will talk about the fixed overhead variances. And under fixed overhead variances, again we are going to start with the fixed overhead cost variance. And for us to compute the fixed overhead cost variance, it is very simple. We are going to have the standard fixed overhead cost, then we subtract the actual fixed overhead cost. That is how we get the fixed overhead cost variance. So other than the fixed overhead cost variance, we have another variance known as the fixed overhead efficiency variance. For the case of the fixed overhead efficiency variance, again the first step is for you to compute the fixed overhead absorption rate, where you will be taking the standard cost, then you divide by the cost driver, which in this case will be the standard hours. Then once you get the fixed overhead absorption rate, then you will be multiplying by the standard hours into you raise the actual hours. Then other than that, the last one is the fixed overhead expenditure variance. And how are you going to get the fixed overhead expenditure variance? The fixed overhead expenditure variance in this case will be given by, you will take the actual hours, you will take the, the fixed overhead expenditure variance in this case will be given by the budgeted, you will take the budgeted fixed overheads, then you raise the actual, fixed overheads, the actual fixed overhead cost. So you are going to take the budgeted fixed overhead cost, then you raise the actual fixed overhead cost. That is how you are going to get the fixed overhead expenditure variance. So lastly, number 4, not lastly, so these are about the cost variances. So other than the cost variances, we have said that we have what we call the revenue variances. And under the revenue variances, the most common are 3 of them. So number 1 is what we call the total sales variance. The total sales variance will be given by, we will talk about the standard total sales. You take the standard total sales, then you raise the actual. Total sales. You take the standard total sales, then you raise the actual total sales. Then number 2, we will talk about the sales price variance. So how are you going to get the sales price variance? The sales price variance, you will take the actual quantity sold, then into the standard price, or what you had budgeted to sell, then you subtract with the actual price. That is how you will be getting the sales price variance. So other than the sales price variance, number 3, we can talk about the sales volume variance. So how are you going to get the sales volume variance in this case? The sales volume variance in this case will be given by the standard contribution. You will take the standard contribution into we are going to have the standard quantity, or we can use what we call the budgeted quantity, then you raise the actual quantity. That is how you are going to get the sales volume variance. Those are basically some of the most important formulas on variances, and once you understand these formulas, it will make your work easier when evaluating the variance analysis. So under variance analysis, so other than these formulas, we have what we call the reconciliation. Reconciliation. We have what we call the reconciliation statement. So how are we going to reconcile our statement using variance analysis? So for us to reconcile our statement using variance analysis, we normally start with budgeted. We'll be talking about the budgeted profit in case they are talking about the profit. If they are talking about the cost, you start with the budgeted cost. Then from there, we are going to have the adjustments, and these adjustments are going to come from the variances that we have illustrated. Number one of the variances we have is material variances. We are going to take note of material variances. Then from material variances we have labor variances. Then we have the variable overhead variances. Then we have the fixed overhead variances. And finally, we have the sales variances. And once you do that, the budgeted profit will reconcile with the actual profit. If we are talking about the cost, the budgeted cost will reconcile with the actual cost. That is how you are supposed to do a reconciliation statement. So therefore, I would like us to look at illustrations in this area and see how these illustrations are very easy. Let us look at some of the illustration in this area. We look at some of the illustrations in this area, and we see how easy these illustrations are. We want to look at illustrations in this area, and we see how easy they are. Once you understand these, it will be very easy for you. And the illustration we will be looking at. So the first illustration will come from August 2023, question number 3A. So the first illustration will be August 2023, question number 3A. Question number 3A, this is the question I would like us to go through and see what the examiner wants. So let us look at that question. This is what you are told. You are told that Zeta Limited manufactures one standard product branded bomber and operates a system of variance analysis using a fixed budget. As the assistant manager accountant, you are responsible for preparing the monthly operating statement, the budgeted information of the product bomber, for the month ended 31st July 2023 was as follows. You are given the selling price, then we have the cost per unit, we have the direct material, we have A and B, then we have direct labor, variable overhead. Then additional information, you are told that Zeta Limited budgeted sales and production for the month of July 2023 was 10,000 units. Then number 2, annual budgeted fixed overhead were shillings 14,400,000, which are assumed to be incurred evenly throughout the year. The company uses the marginal cost costing system for internal profit measurement purposes. The actual data for the month of July 2023 were as follows. Actual production and units sold, you are given 9,000 units. Selling price, you are given. Then we have direct materials consumed. We have A and B. Direct labor incurred, you are told it is 28,500 hours at a cost of shillings 2,736,000. Variable overhead incurred, you are told it is 520,000. Fixed overhead incurred, it is 1,160,000. So required, Roman 1, a budgeted profit statement. Roman 2, actual profit statement. Roman 3, a reconciliation statement of actual profit and budgeted profit, showing or planning and operating variances. Showing or planning and operating what? Variances. So let us look at that question. It is a very easy question. So Roman 1, they need what? Roman 1, they need us to give them a budgeted profit statement. So here we have shillings, and they want us to give them a budgeted profit statement. Budgeted profit statement. So this budgeted profit statement, we will start with the sales. And how do you get the total sales? You take the selling price, which we are given is 800, we multiply by the number of units budgeted. So Roman 1, under additional information, we are told that Zeta Limited budgeted sales and production for the month of July 2023 as what? As 10,000. So you take that, you multiply by those units. So this time this will give us how much? It will give us 8,800,000. Then from there, we raise the cost. We are going to raise the cost. We raise the total cost. So our total cost, number 1, we have direct material. Direct material, under direct material are categorized into 2. We have A and B. So you are going to take A and B. For A, you are told that 2 kgs at shillings 100 per kg. And then we have 1 liter at shillings 150 per liter. But we are going to take per unit. So per unit, they are saying per unit, you are taking 200, and this one per unit is 150. Then you multiply by the number of units produced and sold. The number of units produced and sold, it is 10,000. So therefore, in this case, we will get how much? This time this, it will give us 2 million. It will give us 2 million. Then this one, this time this, it will give us 1.5 million. We are getting 1.5 million. So that is the case of direct material. Then we go to direct labor. Direct labor. For the direct labor, we are told 3 hours at shillings 90 per hour. But we need per unit. Per unit, they are telling us it is 270. And then we multiply by the number of units. Number of units, it is 10,000. So therefore, this time this will give us a total of 2.7 million. 2.7 million. Then once we are done with that, we go to variable overhead. Variable overhead. Variable overhead. Let us get the variable overhead. Per unit, we are told is how much? They are saying 3 hours at shillings 20 per direct labor hour. So therefore the total is 60, then we multiply by 10,000. So this time this, it is going to give us how much? It will give us 600,000. Remember, these are the cost. We are supposed to raise this cost for us to arrive at a profit or loss. So therefore, we are done with that. What is remaining is the fixed overhead. Fixed overhead. Fixed overhead. Let us have the fixed overheads. The fixed overhead. So for the case of the fixed overhead, this is what you are told. Note number 2. Note number 2, they are saying that the annual budgeted fixed overhead was shillings 14,400,000, which are assumed to be incurred evenly throughout the year. So they have, in this case now, the examiner has given us the annual. The examiner has given us the annual what? Annual fixed overhead. But remember, the question is talking about what? The budgeted information of product BOMA for the month of July. So we are given a period of 12 months, so we get for 1 month. How do we get for 1 month? We divide by 12. We divide by 12. So in that case, how much are we going to get? How much are we going to get in this case? So it will be 14,400,000. 400,000. Then from there, we divide by 12. So in this case, it is going to give us 1.2 million. 1.2 million. So therefore, let us compute our profit. Let us see how much are we going to get as a profit. So we take the revenue. The revenue is 8.8 million. Then we raise 2 million. Then we raise 1.5 million. Then we raise 2.7 million. Then we raise 600,000. And also we raise 1.2 million. So we are going to get our budgeted profit here. Budgeted profit. Our budgeted profit will be 800,000. 800,000. So that is how we are supposed to compute for the budgeted profit. For the budgeted profit. That is how we are supposed to compute for the budgeted profit. Once we have computed the budgeted profit, Roman 2, the examiner wanted the actual profit statement. So Roman 2, let us prepare the actual profit statement. Actual profit statement. Let us prepare the actual profit statement. For the actual profit statement, again here we have shillings. So how are we going to prepare this actual profit statement? We are going to start with the sales. But now it is the actual sales. The selling price for the actual, under note 4, we are told that the actual production and the units sold is, we are given 9,000 units, and the selling price is how much? The selling price is 900, and the units were 9,000. So that will give us what? It will give us 8.1 million. 8.1 million. Then from there again we raise what? We raise the cost. And these costs are made up of, number 1, we have direct material. Direct material, we have A, and also we have B. So material A, we are given the total. So direct material consumed, we are given the total. And the total they are saying, it is 2,090,000. Then for B, you are given, you need 10,100 liters consumed at a cost of what? At a cost of 1,414,000. Then from there, we can go to direct labor. Direct labor, again we are given, for the case of the direct labor, what are we told? We are told that the direct labor incurred 28,500 hours at a cost of 2736. 2736,000. Then from there, the variable overhead in the card we are given variable overhead. Variable overhead was in card, we are told is 520,000. 520,000. And then we go to fixed overhead. Fixed overhead. Fixed overhead. We are told the one that was in card is how much? 1160,000. 1160,000. And that's how we are going to compute. That's how we are going to compute our actual profit. Actual profit. So that is our actual profit. That is our actual profit. Let us see how much are we going to get as the actual profit. Again is 8.1 million. Then we raise 2090,000. We raise 14,000. Then we raise 27,36,000 minus 520,000 minus 1160,000. So in that case, we will get how much? We are getting actual profit of 180. 180. 180. So we are done with Roman 1 and we are done with Roman 2. Now, the examiner wants us to reconcile. How are we going to reconcile the budgeted profit and what? And the actual profit. For us to reconcile, we need to prepare the reconciliation statement. And we have said that our reconciliation statement is going to have the budgeted profit, and this budgeted profit will be adjusted with what? With the material variances. And the material variances, for us to adjust these, the material variances we are going to look at is the material price variance and the material usage variance. Then when we go to the labor variance, the tool to help us in reconciling is the labor rate variance and labor efficiency variance. When we go to the overhead, the one that will help us to reconcile, we are going to have the variable overhead efficiency variance, and also we have the variable overhead expenditure variance. Then when we go to the fixed overhead, the variance to help us to reconcile, in this case we will talk about the fixed overhead expenditure variance. When we go to the sales, for the case of the sales, the ones to help us to reconcile will be selling price variance, and also we have what? The sales volume variance. Those are the variances which under these categories are going to help us to reconcile the budgeted profit so as we can arrive at the actual profit. So our examiner is concerned with the reconciliation statement. So let us give the examiner what he wants. We give the examiner what he is interested in. Let us give the examiner what he is interested in. So this is the question. A reconciliation statement of the actual profit and budgeted profit showing all planning and operating variances. Showing all planning and operating what? Operating variances. Showing all planning and operating variances. So let us have the reconciliation. Reconciliation statement. Reconciliation statement. Very well, like this reconciliation statement. Mwalimu said that you start with what? Budgeted profit. Budgeted profit, and we had computed our budgeted profit as 800,000. 800,000. That's our budgeted profit. Then we need the adjustment. Adjustment. We need our adjustment. Our adjustment. So our adjustment, the first case, we have said we start with material variances. And under material variances, we have said we will start with material price variance. And how do we get the material price variance? The material price variance, we said, is given by the actual quantity into the standard price minus actual price. And these materials are categorized into two. We have A and B. A and B. So let us start with A. With A, let us look at the actual. The actual information will come from the note number 4. The actual information will come from the note number 4. Note number 4 is what you are told that the actual data for the month of July 2023 were as follows. You are given the actual production and the units sold, selling price. Then the information for the direct materials, that is what we want. So you are told that A, we require how many kgs? A, we require 19,000 kgs. What about B? We require 10 and 100 liters. Then inside we need the standard price. The standard price will be where we have the budgeted information for the product BOMA. So let us go there. The cost per unit. Then we are told that the direct material. The direct material, we are told A, 2 kgs at shillings, 100 per kg. Remember, we need the cost per kg. The standard price per kg. The standard price per kg. Then the next one is B, product B. Product B, we are told 1 liter at shillings 150 per liter. Then we raise the actual price. Actual price per kg. The actual price per kg will be gotten by taking the total amount paid, then you divide by the number of kg. Note number 4. Note number 4, we are told that the direct material consumed, we consumed for product A, we consumed 19,000 kgs at a cost of how much? We paid 20,90,000. How many kgs? We divide by the number of kgs for us to get per kg. So per kg we are getting how much? 110. So when you take these, you divide by these. When you take these, you divide by these, it is giving you this one. That's how we get per kg. Then let us get per liter. Per liter again, you will come to product B, to this B, you take this total, you divide by this one. This total, you divide by this one. How much are you getting? So it is 14,000. Then you divide by this one. It is 100. So this price will be 140. That is what you have. So therefore, let us get our answer here now. Our answer here now will be The first one will be 19,000 into bracket 100, then 110. So you are getting what? You are getting the answer. We are getting, it is negative 190. But in variances, we don't write the negative or positive. In variances, we don't write the negative or positives. In variance, we use these two terms. So the term we are going to use is, one is adverse and the other term is favorable. Favorable. So you use adverse or favorable. You can say that it is favoring you, it is favoring the company. If we are talking about the cost, it is favoring the company when the company is paying minimum cost. When the company is paying a cost less than what they had budgeted for, we normally say that is favorable. It is adverse when the company is paying more than what they had budgeted for. In this case, they had budgeted that per kg they are going to pay 100. They ended up paying what? 110. So in that case, did it favor or it did not favor? It is 190, and this 190 is what? Is adverse. We paid more than what we had budgeted for, and we are talking about what? The cost, material price. Then the next one will be 10, 100. Then from there into bracket, we have 150. Then we less 140. So how much are you getting? So in this case will be 101,000. This is 101,000. So in this case, we had budgeted that we will be paying 150. We ended up paying 140. We paid less than what we budgeted for. Less than what we budgeted for. So that is favorable. That is favorable. That is favorable. So we are done with the material price variance. And under material, remember, Mwalimu had said that we are going to look at two variances. Material price and material usage variance. Material usage variance. So for the case of material usage variance, how are we going to get the material usage variance? The material usage